All right, welcome to The Explainer. Today we're digging into a sneaky little tax trap that could be costing you real money on your bond investments. It's called phantom income, and trust me, you're going to want to know how to find it, and more importantly, how to fix it.
So here's the deal. If you bought a bond last year, that 1099 INT form you got, it might be lying to you. And I don't mean a little white lie. I mean, it could be making you pay taxes on money that never even touched your bank account. And this isn't some random mistake. It's a flaw in the system itself. But don't worry, we're going to crack it wide open.
All right, here's our game plan for this little forensic audit. We're going to start with the problem itself, this silent tax leak. Then we'll get into the nitty-gritty of a bond deal to see how it happens. I'll show you exactly where to look on your own broker statement to find the proof you need. And then the big one, the step-by-step fix, both on paper and in your tax software. And finally, we'll connect the dots and see why this is so important for your retirement. Okay, Section 1. Let's get one thing straight right off the bat. This is not your broker messing up. It's a fundamental flaw in how taxes are reported. It creates this thing called phantom income. And honestly, so many investors walk right into this trap and have no idea.
So what exactly is phantom income? Well, think of it like this. It's income that shows up on paper, assigned to your name, but you never actually get to keep the cash. The problem is the IRS taxes the piece of paper, not the reality of your actual profit.
And this right here, this slide just lays it all out perfectly. On one side, you've got the IRS default. They see the whole big gross interest payment and say, yep, that's taxable. But on the other side, there's your economic reality, your wallet, which knows you only actually profited the net amount after you paid the seller their cut. You're getting taxed on the big number, but you only ever pocketed the small one. See the problem?
All right, let's get into the mechanics of it. How is this phantom income actually created? It all happens during a totally normal bond purchase. It's all about understanding the timing of how interest gets paid. You know, the best way to think about a bond is like a rental agreement for your money. The company or government that issued the bond is paying you rent, that's the interest, for the privilege of using your cash. Now, that rent, that interest, it's adding up every single day. But, and this is the key part, it usually only gets paid out in one big check twice a year.
So what happens if you jump in and buy a bond, say, halfway through one of those 6-month periods? Let's say you buy on April 1st. Well, the person who sold it to you has already earned 3 months of that interest rent. To keep things fair, the market makes you pay them for that interest they've already earned. That's called accrued interest, and you pay it to them right up front when you buy the bond.
Okay, this table shows you exactly where the trap is sprung. Let's say you get the full $250 interest check on the payment date. Looks good, right? But wait, you already paid $125 of that to the seller when you bought the bond. So your real, true, actual profit is only $125. But what does your 1099 INT say? It reports the full $250 as taxable income. That extra $125, that, my friends, is pure phantom income.
All right, time to put on our detective hats. We know the phantom income exists, but where do we find the hard evidence, the exact number we need to fight back and correct the record with the IRS? Well, it's hiding in plain sight in your broker statement. You just have to know the secret hiding spot.
Look, your broker, Fidelity, Schwab, whoever, they know this happens. They know you paid that accrued interest. The problem is, IRS rules force them to report that big gross number on the main 1099 INT form. So where's the number you need? It's not on page 1, I can tell you that. You've got to dig. Scroll way down, look for a section called Supplemental Information or Year-End Summary. Buried in there, you'll find a line item, Accrued Interest Paid on Purchases. That's your golden ticket.
Okay, we found our evidence. We have that accrued interest paid number. Now we can finally execute the fix. And this isn't some sketchy tax loophole. This is the official IRS-approved method for correcting your tax return.
Now, this is absolutely critical. There's a right way and a very wrong way to do this. The wrong way is to add that accrued interest to the cost basis of the bond. Please don't do that. It's a huge mistake. All that does is turn a really valuable immediate deduction into a much less useful capital loss that you might not get to use for years. The right way, the smart way, is a direct income adjustment on Schedule B. And here it is, the exact protocol, straight from IRS Publication 550. It's a 4-step process. Step 1. On Schedule B, you list the full gross amount of interest from your 1099. You have to do this because it keeps the IRS's automated computer systems happy and prevents them from sending you a scary letter. Step 2. You create a subtotal.
Step 3, and this is key, on the very next line, you write these exact words, accrued interest. And finally, step 4, you enter the amount you pay the seller as a negative number. Bam! Phantom income gone.
Okay, so you've mastered the pen and paper fix, but what about the digital world? If you're using tax software like TurboTax, there is one more nasty little surprise you need to watch out for.
And hey, don't just take my word for it. Listen to this poor soul from a TurboTax forum. He figured out the software's glitch cost him $1,500 on a prior year's return he didn't catch. This stuff is real. The software's default settings, especially when you have a consolidated 1099 with different kinds of bonds, can lead to some seriously expensive mistakes.
So here's the glitch. Your software sees that accrued interest deduction, but it doesn't know which type of bond it came from. So what does it do? It just kind of guesses. It spreads the deduction out proportionally over all your interest income, and that is dead wrong. It might end up taking the deduction away from your fully taxable corporate bond income and applying it to your treasury income, which is already tax-free at the state level. That mistake means you end up overpaying your state taxes.
So what's the pro move here? It's what we call the split form protocol. You have to fight the software's instincts. Instead of entering your consolidated 1099 as one big form, you manually break it apart. You create one 1099 entry just for your corporate bonds and apply the corporate accrued interest there. Then a second one for your treasuries and apply its deduction there. You get the idea. It gives you surgical precision. Now, if that sounds like a headache, that's okay. This is a perfect example of when it's worth the money to have a good tax pro handle it for you.
Okay, so why do we just go through all that detail? I mean, this is a lot more than just saving a few bucks on one bond trade. This is about preventing a domino effect of negative consequences that this phantom income can trigger across your entire retirement.
See, when you don't correct for phantom income, it artificially inflates your adjusted gross income, your AGI. And that one number on your tax return is a tripwire for what's called the tax torpedo. A higher AGI can suddenly make more of your Social Security benefits taxable. And maybe even worse, it can jack up your monthly Medicare premiums.
Let's take a look at a real-world example, the Medicare IRMAA cliffs. For 2026, the second your income as a single filer ticks over $103,000, boom, you get hit with a surcharge. Just a few $1,000s in uncorrected phantom income could easily be the thing that pushes you over that cliff, triggering higher premiums for Medicare Part B and Part D for a whole year.
And this chart just drives the point home. Look at this. With the phantom income, this person's income is just over the line at $105K. After our simple Schedule B fix, it's back down to $101K, safely under the threshold. That tiny artificial bump in income was about to cost them hundreds, maybe even thousands of dollars in extra Medicare surcharges. Making this one simple fix saves all that money.
So, here's the bottom line. The system has a built-in flaw, but thankfully, it also has a documented, official fix. You now have the complete blueprint. You know how to spot the phantom income. You know where to find the evidence on your statements, and you know exactly how to correct the record with the IRS. You've seen all the evidence, so the only question left is, will you audit your own return before you file?